Humans are compelled to have an emotional component to every action they take. It is in our nature. This can also happen when it comes to financial investments. One important factor in financial decisions is stock market emotion, which influences investors' trading psychology significantly. However, in order to be a successful investor, one must always keep one's emotions in check. Hey there, welcome to the Daytime Dollar, where we talk about financial strategies and how small changes can make big improvements. Today, we are talking about in this video, we will discuss how to avoid emotional investment. Hit the subscribe button and press the bell icon for more informative videos. Let's get into it. Number 1. Investors feel more optimistic than necessary. The optimism phase is generally characterized by a positive trend. Market values continue to climb and investors are ecstatic as their accounts grow. As a result, many investors who are unaware of market patterns are enticed to participate, regardless of their risk tolerance levels. If the market boom lasts for a long time, the enthusiasm will continue to grow. As a result, even experienced investors may believe they can take on more risk. Number 2. Check your portfolio no more than once a year. Invest for the long term. Checking your portfolio no more than once a year will help you avoid any temptation to make updates to your investments as the market changes. To best weather the market's ups and downs, you should leave your investments alone for the long haul, following the math rather than the excitement of the stock market. The more fixated you get on the daily news cycle, the more tempted you'll be to jump in and do something, again succumbing to the illusion of control. Number 3. Ask big picture questions. There are reasons why you began investing in the first place, which in turn help determine how your portfolio is constructed. It may be helpful to revisit these goals when volatility picks up to see if anything has changed. Consider asking yourself questions like, are my goals the same now that my investments have declined? Is my financial situation the same? Does my portfolio have an appropriate level of diversification? If the answer is yes to a majority of these questions, then ask yourself why you need to make any changes, particularly knowing that there are risks to getting it wrong. Number 4. Investors start panicking. As the crisis persists, investors become increasingly concerned. Most of them now want to sell, including those who thought the decline was only temporary. Investors are now desperate and in surrender, having already lost some money, as the facts of a bearish trend have become obvious. They want to get out to avoid more losses, and even those who keep their assets aren't optimistic about a rebound. Number 5. Stop keeping track of your investments on a daily basis. Stop tracking your investments on a daily basis to reduce the emotional impact of market volatility. During times of market volatility, obsessively checking your investments can cause anxiety and make you vulnerable to emotional investing. Stock markets have historically rewarded those who stayed committed to their investments despite market volatility. Block out noises and don't be swayed by rumors. You increase your chances of staying on track by not tracking your investments on a daily basis. Number 6. Seek the advice of a financial advisor. Consult a financial advisor to gain a better understanding of your situation and to buy time. Expert advice can help you see the big picture and make better decisions. Financial advisors with years of experience can help you navigate choppy waters with ease, avoiding impulsive trading and overestimating your risk tolerance. It allows you to rethink your investment strategy and better assess your risk tolerance. It assists you in being logical and rational in your investment decisions. Number 7. Review your time horizon and your risk tolerance. No one can predict when the markets will rise or fall, or by how much. This makes timing the market next to impossible. That's why your investment strategy from the outset is based on your goals, your risk tolerance, and your time horizon, not the markets. For example, if your time horizon is long, you're likely comfortable taking on greater risk and you may experience greater impacts from market fluctuations. So your investments are less impacted by market fluctuations. Whatever the case, it's important to keep market fluctuations in perspective. Number 8. Be informed by the news. When the market falls, the surge of headlines can be a great source of stress and anxiety. Remember, media and news reports can be informative and beneficial, but they shouldn't be a driving force in your decision-making. Market declines always need to be put into perspective, with your goals at the center. And speaking with a financial professional can add far greater value than merely following the headlines. Number 9. Buy low, sell high. This requires you to set aside your emotions because you're doing the opposite of what the market is doing. When the market is at a high, people tend to want to enter the market. However, this is the time to sell what has outperformed in your portfolio and buy what has underperformed. To help you buy low and sell high, pick a time once a year to rebalance your portfolio back to your target asset allocation. Number 10. Brace yourself in advance for market collapses. Knowledge is an essential asset when you're investing. Understanding how the markets and stocks work can help alleviate investor fear. You can also reduce anxiety by becoming more familiar with the economy, investors, businesses, and government influences on the market. Markets plummeting triggers only one thought in investors' minds: how much value their investments are suddenly losing. While it's human nature to want to react quickly to dips in the market, resist impulsively making changes to your portfolio out of fear and panic. The market can just as well go up as quickly as it can go down. Keeping your cash invested throughout the fluctuations is what helps your money grow over time. So guys, that's all about today's topic. See you soon in the next video.